let's talk about a single mortgage deal worth over $600 million. Now, I know it sounds like just another crazy number you'd see in a headline, but it actually tells a fascinating story about a huge shift in who can buy a home in America today. So here it is, $602.7 million. And get this, that's not the total value of the housing market. That's the size of one single deal from a company called AD Mortgage, and it's the biggest one they've ever done. But what does a number this big really mean? For the market, sure, but what about for regular people trying to buy a home? Well, that's what we're going to do. We're going to cut through all the jargon and get to the bottom of what this deal really signals.
To really get what's happening here, we need to understand two key financial terms. Don't worry, they're simpler than they sound. First up is securitization. All securitization means is that a lender takes thousands of individual home loans, bundles them all up together into one giant investment product, and then sells off pieces of it to major investors, like JP Morgan and Barclays. Probably the best way to think about it is like you're making a smoothie. The individual mortgages are all the different fruits. You throw them all into a blender, that's the big investment pool, and then you pour out individual glasses of that smoothie, the securities, and sell them to investors. It's really just a way to turn thousands of small loans into one big thing that's easy to trade.
Okay, so that's securitization. The other term you need to know is non-QM. It just stands for non-qualified mortgage. Basically, it's a type of home loan made for borrowers who don't quite fit into the traditional, neat little box. And here's the key difference. A traditional loan is all about your W-2s from a steady job. But what if you're a freelancer or you own a small business? A non-QM loan lets you use other things, like your bank statements or a profit and loss report, to prove you can afford the house. It's just a different way to verify your income. So now that we've got the lingo down, let's take a look inside this actual $602 million pool. Who are the people behind all these loans? That huge number is made up of 1,793 individual home mortgages. Every single one of them represents a family or a person buying a home. These are the fruits that went into our smoothie. And this, right here, is really the core of the story. A massive 84% of the loans in this giant pool were approved using alternative documentation, not W-2s. That one fact tells us so much about who these homebuyers are. So who are these people? Well, it's really important to say this isn't about subprime lending or anything like that. This is about the modern workforce. The vast majority of these homeowners are self-employed people, freelancers, folks with variable incomes who are just proving their financial stability in a new way. But does non-traditional income mean risky? Well, the data says not at all. The average credit score here is 748, which is very, very good. And with a loan-to-value ratio under 69%, the average borrower has more than 30% equity in their home. These are financially solid homeowners. A couple other details help round out the picture here. Pretty much all the loans, 99.9%, have stable, fixed interest rates. And what's interesting is that while 84% used non-traditional documents, only 22% are officially categorized as non-QM. It just goes to show how these definitions can be kind of complex. The main thing is that these are well-structured loans to really solid borrowers. Okay, so we've broken down the jargon and we've looked at the borrowers. Now, let's zoom out. Why does this one financial deal actually matter in the grand scheme of things? This quote from an asset manager who is involved pretty much says it all. He says it reflects the confidence investors place in non-QM mortgages as a premier asset class. In plain English, that means big money is now very, very comfortable lending to people who don't have a traditional 9-to-5 job. And this isn't some one-off thing. It's a clear trend. You can just see the rapid growth in the size of these deals from this one company alone. They've gone from around $400 million to over $600 million in just a matter of months. I mean, the momentum is pretty obvious. So let's just sum it all up. What does this tell us? First, the market for these non-traditional mortgages is getting stronger. Second, huge investors now see them as a safe, top-tier asset. And most importantly, all of this means that the paths to owning a home are getting wider, adapting to the reality of how people actually work today. Which, of course, leads to a much bigger question. The whole idea of a 9-to-5 job for life isn't really the only path anymore. So, as the very nature of work continues to change, you have to wonder, could these flexible mortgages stop being the alternative and actually become the new standard?